Hello, everyone. Thank you for joining us today for the Satrix IndexMore New Listings webinar. I'm Renee Basson. I'm Head of Brand at Satrix. And before I introduce the panel to you, I just want to touch on a few housekeeping items. We are recording today's session and we'll share the on-demand version with you via email. This webinar does not qualify for CPD points with the FPI, so just FYI on that. I do recommend that you close any programs and browser sessions running in the background. And if you are on your VPN, please log off. This does help with your viewing experience. And if your slides don't progress or your video buffers, please push F5 on your keyboard or Command R on a Mac to refresh your browser page. We value your feedback, and there will be a pop-up survey at the end of the webcast, so please do complete that for us. I'm very pleased to introduce our panel today. With me, I have Kingsley Williams, our Chief Investment Officer at Satrix. We have Mark Randall, the Director of Information Services from the Johannesburg Stock Exchange, and Nico Katska, Head of Portfolio Solutions at Satrix. Welcome, gentlemen. Thank you for joining us today.
Thanks, Renee.
Thanks, Renee.
Great. So we've got a lot to cover, so we're going to dive straight in. Kingsley, I'm going to give you the first question. Satrix hasn't launched a new product in a while. Can you give us an update on what you've been busy with and how the Satrix business is doing?
Sure, Renee. Very happy to do that. And welcome to all our listeners. Thank you for joining us this morning. So very quickly, Satrix has now passed the 200 billion mark in terms of assets under management. So across all of the different products and mandates and funds that we manage on behalf of clients, collectively that now makes up 200 billion in assets under management. So we're very pleased with that milestone. And we're particularly grateful to all of you, our clients, that have continued to support our business and allocate your hard-earned savings into some of the strategies that we manage. We do appreciate times are tough and budgets are constrained. So thank you very much for your ongoing support over the years. Just in terms of what our business has been busy with, last year consumed a lot of our capacity in terms of onboarding the new funds, which we acquired from ABSA's ETF business. And we've been consolidating our product lineup to ensure that we have a coherent offering and a framework of different strategies that we are able to offer clients in order for them to build their portfolios. We are also seeing ongoing growth and increased share of our, of the indexation market, particularly within the ETF space. So that's also very encouraging to see. And then what we've been doing last year is very much laying the groundwork to be able to bring new products to market in 2024. And that's certainly what we're going to be spending more time talking about during the next half hour.
Great. Thank you, Kingsley. So, Nico, before we get into what Satrix has planned, can you give us a quick overview of what drove market performance in 2023?
Yes, thanks, Renee. So 2023 was an interesting year. If we look at local markets, so what I show you on the screen here, first thing that stands out, of course, is that resources lagged very strongly, losing 13.2%. For the year, despite Harmony and Goldfields, for example, delivering very strong results. Financials were up quite strongly, and property stocks as a group actually continued to show some strong recovery from its COVID lows. Also interesting to note that cash there, Steffi, delivered 8%, which is nearly 3% real. And we've stressed this in the past. Before this, this is certainly nothing to scoff at. And also notice the big difference between returns of the SWIX and the Aussie. Again, in fact, it's actually contracted somewhat since June last year. But this is all due to the Aussie's superior returns coming from a stronger rand hedge, and specifically its big overweight to Richmond. Now, if we look at it from the year from a style perspective, which is always interesting as well, this rolling 12-month relative return graph actually shows a strong mirroring of performance for the local, global versus value versus growth indices that you see at the top there, as well as on a global basis, the value versus growth indices, both relative to their parent index. So the top one is relative to the capped SWIX, the bottom one is relative to the MSCI World. Now, what is interesting, and of course, this is this classic dichotomy between value and growth is always interesting to understand what type of market regime we're in and which type of companies actually tend to perform better than others. Now, what is interesting is that many have pointed to, in the past, to a lack of a true growth index in South Africa. But clearly ours align very nicely to the global lived experience. So again, quite interesting for us to see that. And we've covered in previous webinars how we interpret this, whether we're in a growth or a value cycle. But suffice to say, it will be very interesting to see whether value could indeed make a comeback this year. As you can see, their growth running ahead both locally as well as globally towards the latter part of this graph. Although that values rebound will likely require rates to remain a bit higher and inflation to persist longer than currently expected. The last thing I want to show you, just to get you up to speed with what the markets did in 2023, is that clearly the dominant theme for 2023 was no doubt how you managed currency exposure. So on this graph, we show the top 25 Rand hedge stocks on the left, the green distribution there, and the stocks as a group delivered an average return of 24.5%. Now compare this to the less than 4% return that the Rand play stocks delivered. In other words, stocks that do well, you'd expect to do well when the Rand is strong. Now, clearly, having had the hedge stocks in your portfolio would have had almost a disproportionately large impact on the performance of any strategy in 2023. So with styles having caught up with the index that has run hard, your Rand hedge stocks having done well, and growth stocks having done well, it's kind of the background, I think, to what markets did in 2023. And it'll be really interesting to see whether this trend persists in 2024.
Great. Thanks, Nico. Kingsley, I'm going to bring it back to you. Satrix is going to be launching an ETF that tracks a new local equity index. Do investors need another local equity index, and what does this one offer?
Yeah, thanks, Renee. So hopefully what the listeners can see on their screen, and I think some may be having challenges viewing it, but I think the environment is configurable to be able to make that bigger on their side. So that's the beauty of this platform. You should be able to zoom in and make the slides your main view. But what you can see within our market and within our product lineup, particularly within the equity vanilla space, is that there's never been a shortage of choice from an index tracking perspective, and that's often why we say indexation is anything but passive. There are a lot of investment decisions that need to be made, even if you do decide to track a market cap-weighted index. And often a conundrum that investors have faced is choosing between an all-Z-based index, or the top 40, for example, which is a subset of the all-Z, or a Swix-based approach. And this has often resulted in quite different exposures and at times quite different return outcomes. As Niku showed earlier, there was a difference between the all-share and the cap Swix index last year. But our market has also been on a journey, which is why we're delighted to have Mark Randall joining us from the JSE to provide us with some background on how it has evolved and also what is going to be happening this year in terms of index harmonization.
Great, thanks. So Mark, over to you now. So Kingsley has just mentioned index harmonization. What is it exactly?
Hi, Renee, and thanks for that question, and it's good to be on the webcast. So the FTSE JSE partnership has provided benchmarks into South Africa going back to around about 2002, so a very long-standing offering of indices. I think what's really important is over that time, certainly since 2004, we've really maintained two parallel sets of benchmark indices. On the one hand, the flagship all-share index, on the other hand, the Swix all-share index. Now, these two variants have offered quite differentiated views and returns over the past 20 years, really allowing the South African investor to choose the variant that fits most closely with their own investment mandate. However, as our market has evolved, we've seen these two approaches really become more and more similar over the past few years, and to the extent that they're no longer really providing the fully differentiated view that they once did. So in order to simplify our index offering in our landscape and reduce the amount of noise in the market and centralize liquidity and hopefully reduce some costs, we've therefore decided to merge these two different index methodologies into a single harmonized approach.
Great, thank you. So simplification and less complexity seems like good outcomes. But what exactly is changing and when, Mark?
So as I said, at the moment, we've got these two variants. In the tradable space, this would be the top 40 index and the Swix top 40. They're pretty similar at the moment. There are only one or two companies that are really treated fundamentally differently in terms of their weighting. So after a consultation process, we've really decided to stick with the Swix weighting. That seems to be the vastly preferred methodology in South Africa. So what we'll be doing is tweaking the weighting for our all share and the top 40 indices so that they end up looking identical to their Swix counterparts. So it really just is a rebalance to our top 40 index and our all share index. Once we're done with that, the two indices will look identical in terms of weighting and performance going forward. I think important to note, we're not renaming or terminating anything at this stage. So the old indices continue, even though their return profiles will be the same. And this is all taking effect at our quarterly March index review. So that will be effective from Monday, the 18th of March is our implementation date.
Okay, great. Mark, you mentioned consultation. So throughout the process, the JSE has included index user inputs. And how has the market received the news of the harmonization?
So I think this is really important because as the JSE, we fully recognize that good benchmarks and good indices are really structurally important of the South African capital markets. These are things that people use for performance benchmarking, for tracking their investments, for asset allocation. And as an independent benchmark administrator, we have to make sure that we're getting this right and that we're getting the right product to the right people in the market. So we have been consulting for quite a lengthy period about this index harmonization project. And generally, I would say when you look at index methodology, we try to err on the side of longer consultation periods and longer notice periods, just so that nobody is caught flat-footed. So in this particular case, we started the conversation with our institutional clients and managers probably about 5 years ago. There have been several white papers, road shows, scenario planning, and so on that we put out to the market, and working groups. And ultimately, we believe that our full client base has an opportunity to be involved in the process. Of course, whenever there's a change to index methodology, you're not going to make everybody happy with the outcome. So there is an element of give and take. On the one hand, we're simplifying and reducing the offering. On the other hand, that does mean we lose some of the variance. But I do believe that ultimately all of our clients have had an opportunity to be involved in the process and have sight of what's coming down the pipe.
Great. Thanks, Mark, for providing that context for us. So Kingsley, what is this new index called and what does it offer investors?
Yeah, thanks, Renee. Before I get into that, I mean, the index itself is going to be called the FTSE JSE Global Investor Index. And what it's going to do is provide investors with much higher exposure to all of the dual-listed companies that are available on the JSE. It's different because the ALSI indices historically provided higher exposure to only some of the dual-listed companies. And these were known as what we call the grandfathered companies. But this new index that's going to be that is now available and which we're going to be launching a product against considers all of those dual-listed companies at their global free float, regardless of whether they're grandfathered or not. So it chooses the largest 50 stocks within the all-share universe and caps a company at 10% at each quarterly rebalance to ensure diversification. So just what I'm showing you on the slide here is just how the indices, the all-share index has changed through time. So this was as at December 2021, and you'll see that the grandfather companies indicated by an asterisk had quite large weights, Anglo's, BHP Group, and Richemont. And those dual-listed companies altogether made up 45% of the index. But because of changes to the way those companies are incorporated and structured, they've lost their grandfather status through time. And you can see that Richemont over here now is at the end of 2023, and BHP Group also at the end of 2023 have had a greatly reduced weight. So it's only really Anglo's and if one or two others, as Mark was mentioning, that still have a large weight. And as such, the dual-listed exposure in the all-share index now is sitting at around 27%. The Swix index, which we've also been tracking and offering through various products, actually downweights all of those dual-listed companies, and it only considers the local free float. So if I show you this picture between 2021 and 2023, you'll see the changes are not so significant within the SWIX index because those companies' grandfathered status doesn't affect the weighting of those companies. So if I flick back between those 2 points, you don't see much of a change there. So now, if we go forward to the Global Investor Index, as I was mentioning, this is going to include higher weights to all of these dual-listed companies. And you'll see that all of those collectively make up almost 2/3 of this index. So if we recap what Mark has shared, you'll see the downweighting of grandfathered and dual-listed companies in the ALSI indices through time, while the SWIX variety has remained relatively stable because all of those companies are downweighted in the SWIX variant. The global index, though, the Global Investor Index has a much higher weight to all of those dual-listed companies, which it includes, some of which have had quite insignificant weights within the all-share index and the SWIX index, such as AB InBev, which was the old SAB. If you recall, British American Tobacco is also a very underrepresented company, Glencore, and then now more recently, BHP and Richemont were also downweighted. But you'll see within the Global Investor Index, they have a much higher weight. And hence the reason you have about 2/3 exposure to dual-listed companies in this index.
Great. Thank you, Kingsley. So Nico, next question is for you. What is the implication of having higher weightings to these dual-listed companies? Can you give us some insight into the characteristics of this index, please?
Thanks, Renee. So from what Kingsley showed us, investors are getting significantly higher exposure to companies with primary offshore listings of nearly 2/3 compared to the capped SWIX's current 20.6%. So a significant 40% increase, 40 basis point or percentage point increase. Now, the net effect of this is that a significantly higher proportion of the index's earnings will be coming from offshore, which naturally implies a stronger rand hedge to this core local equity allocation. But just how strong, you might ask, right? So on this graph, we compare the average 3-year rand hedge exposure of the different local equity indices compared to the ALSI, using MSCI's rand sensitivity scores for each listed company to the dollar, pound, and euro. Now, from this, it is clear that the SWIX has a more of a rand play hedge. In other words, if it's in the positive territory relative to the ALSI, it's more of a rand hedge. And you can see that the SWIX methodologies is more of a rand play and significantly more so. But what's also clear from this is that the Global Investor Index that you see on the right offers a very strong rand hedge alternative, very strong in the negative direction. Now, when we think of currency hedging, it's typically a fluid definition and not cast in stone, of course. So this slide shows us a rolling 6-month rand hedge comparison for the different local indices. And it shows that over the past 2 years, the difference between the SWIX and the ALSI has all but diminished, as you can see towards the latter end of the chart. Again, the zero line is the capped SWIX, and anything below that means the index is more of a rand hedge. Now, from our earlier slides, this can actually be a key determinant of performance should the currency uncertainty and weakness repeat in the future, as it did in 2023. As you recall that slide that I said, that was the dominant theme in 2023, and getting your currency hedging position right meant all the difference. Now, how does this actually translate into performance? So if we look at performance, the Global Investor Index had a performance profile more similar to the ALSI methodology, as you see at the beginning of this chart, and this is now, again, a rolling 12-month return. But in the past 2 years, it's actually increased offshore exposure to primary listed companies that Kingsley mentioned, meant that it delivered quite strong results through 2023. Now, notable from this graph too is that these periods of strong performance typically coincide with periods of strong rand weakness. You can see there that I shade in red. Now, of course, the next question is whether how this actually plays out in your portfolio, but certainly it delivers as expected from a performance perspective should the rand actually weaken.
Great, thank you. So Nico, with higher exposure to the rand, which can be quite volatile, should investors expect a more volatile index?
Yeah, so when it comes to realized volatility, to your point, one might expect that a more concentrated index with fewer stocks, as the global investor is, should experience more volatility. But it actually turns out that in recent quarters, its volatility has actually been lower. So this graph shows rolling 12-month standard deviation or realized volatility of the different indices relative to the capped Swix, again, the zero line. So if it's above the line, meant it experienced more volatility, and below the line, less volatility. Now, so actually the reduced volatility that we see over the past few quarters, we actually seeing volatility offsetting at play. That's similar to what we've seen and discussed in the past on our balance funds, with foreign equity volatility actually being offset by rand weakness. Now, this might then combine well to offer investors the return upside that I showed you on the previous graph. Combine that with lower volatility should the currency indeed weaken, as you see here towards the latter part of the graph. And so this might combine well in the client's portfolio. Now, this might seem puzzling, right? As I mentioned, it's a more concentrated portfolio. You know, the rand is quite volatile, and it has a high exposure to rand's weakness. So this might seem unintuitive that you do find reduced volatility. But think of it intuitively as follows. Suppose consumer sentiment weakens offshore, and this hits, for example, Richemont's share price by 2% in euro terms. Now, we'd expect such a souring of consumer sentiment to actually impact the rand as well. So, for example, we might see the rand weaken by 2% as a result. Now, the rand would then act as a downside offset and volatility dampener, because if Richemont falls by 2% and the rand weakens by 2%, on a rand basis, you're actually at zero. And this is why we say this increased rand hedge exposure might actually lead to increased performance as well as lower volatility should the rand in fact weaken. Of course, none of this is guaranteed, but it's just interesting to note the past this has indeed happened.
And Nico, if I might just add there, we actually saw this play out in December 2023, where we had some particularly strong market movements around the index rebalance. In fact, on Thursday, the 14th of December, our local equity market was up almost 4%. I think resources were up in excess of 8%. And that coincided with our currency strengthening, as indicated here by a negative number. In other words, the dollar weakened by about the same margin. And so we saw a much lower increase in the Global Investor Index on that day because, based on what you were describing, the currency was offsetting some of that strong equity performance because some of those equity stocks were priced offshore, and so with the currency strengthening, that would offset some of the moves in rand terms. So you saw a lower return on Global Investor of 2.5% versus our market, which was up almost 4%. But then, interestingly, the reverse also happened the following day. The Friday was a public holiday. So on Monday, the 18th, our market gave up some of those gains. So it was down 1.5%. And our currency weakened by even more than that, 1.7%. And as such, the Global Investor Index also had moved less because the weakening currency boosted some of those stocks or offset some of the movement in those stocks. So they didn't go down as much. And so the Global Investor Index was only down 70 basis points on that day. So that, again, just shows the lower volatility that you get, or that you can get from this index when you have that strong movement in the currency.
And then it can act as this ballast in your portfolio to protect you from rand weakness and reduce volatility and improve performance. So it's a great quiver in your arrow, so to speak, adding this in your portfolio as well.
Great. Thank you. Kingsley, are you advocating this as the core equity exposure for clients' portfolios?
Well, Renee, there are a couple of ways to answer that question. I think the first thing is to make it very clear that, as a product house, we don't provide advice. So if clients are unsure about what they should be including in their local equity portfolio, then they should be seeking advice. However, I would view this as a strategy to complement existing domestic equity exposure that clients may already have within their portfolio. So particularly if they feel now with the index harmonization as we've described it, which would, for example, downweight Anglos in the top 40 index and has downweighted BHP Group and Richemont over the last 2 years, that they might feel now that perhaps they don't have the same degree of rand hedge exposure in their local equity portfolio that they used to have in the past. And Niku showed you those rolling rand hedge exposure charts, and you can see that how the ALSI and the capped all share index, and that would apply to the top 40 as well, have now started converging more to look like the SWIX and the cap SWIX. In other words, having less rand hedge characteristics. So for investors that want more of that rand hedge exposure and more exposure to the dual listed companies that are also listed on the JSE, then this would be a great complement to add to their portfolio. Another interesting angle is that there are certain institutional investors who may need to comply with Regulation 28 of the Pension Funds Act and various other prudential limits. And they may want to increase exposure to offshore revenue sources and earnings on the local portion of their assets, because they might already be utilizing the full offshore allocation within their portfolio, which is limited to 45% currently. And so this would be a way to say, if you want exposure to more sources of foreign earnings within your local, within your Reg 28 compliant portfolio, this would be a way to get that through your local equity portion. So you can increase that global equity allocation via this strategy without exceeding the 45% limit on offshore investments. And in fact, there are even other investors that aren't allowed to invest in offshore equities. There's certain prudential limits that govern them in that regard. So this would be a way to get some exposure to offshore earnings and equity exposure offshore without explicitly direct investing outside of South Africa.
Great. Thanks, Kingsley. So when is the Satrix JSE Global Equity ETF listing, and what will it cost?
So we don't have the exact date just yet. It's going to be in this first quarter at some time. So please just keep an eye on the press, and you should see that coming out any day from now. And that's, there'll be quite an extended period before it lists, in which investors can take up and subscribe for units via an IPO. And then it should hopefully list towards the end of this quarter, and ideally before index harmonization occurs, so that investors can then utilize this fund to compensate for the final step in the index harmonization process. I showed you earlier in one of these slides, I'm just going to bring that up very quickly just so investors see it visually. And I just want to point it out. It's going to be known as STXJGE. That'll be the ticker for this instrument. Hopefully you can see that on your screen. And it's going to have a very, very competitive total expense ratio of 15 basis points. So I know some other providers have brought products to market. They might be actively managed. They seem to have quite a higher sticker price associated with them. This is going to be very competitively priced at 15 basis points. So a great way to access this dual listed exposure that the JSE offers, which historically investors wouldn't have had full exposure to, and obviously with index harmonization occurring, have had less exposure to these companies through time. So a great way to complement their portfolio.
Fantastic. Thank you, Kingsley. So it sounds like this ETF will provide equity investors with greater choice within the domestic equity portion of their portfolio. But what about investors wanting direct offshore exposure?
Yeah, so wait, there is more. That's not everything. We're adding another ETF. So let me just make sure that this comes through. It's going to be called the Satrix MSCI ACWI ETF. So it will allow investors to invest into offshore equity markets directly. So to complement investors wanting to get increased exposure to the dual listed companies on the JSE, we will be also offering an ETF that provides offshore exposure. So many of our investors will be familiar with the MSCI World, the Satrix MSCI World products that we offer in both unit trust and exchange traded fund form. The ACWI includes the emerging markets. So maybe just to contextualize, MSCI World offers exposure to developed markets only. And for example, your S&P 500 would give you exposure to the US, which makes up the big portion of the MSCI World, the large cap stocks only. The NASDAQ 100 would also form part of MSCI World, and that's just a subset of the US exposure, excluding financials. But what MSCI World doesn't include are the emerging markets. And that's where the likes of China operates, India, various other countries. So when you combine the world and emerging markets together, you get what we call ACWI, or MSCI All Country World. And so you'll see just on this visualization drawn roughly to scale is that you get exposure to all of those other emerging markets as well. So with a single share, you'll be able to invest in the entire equity universe, global equity universe, through one share. And we're going to price that ETF at the same fee as our MSCI World. So that'll be at 35 basis points to get ACWI exposure. And that's also going to be listing in this first quarter. So again, watch the press for that. It'll be coming around anytime soon.
Awesome. Thank you so much, Kingsley. So Mark, Kingsley, Nico, thank you very much for joining us today. We're out of time. And thanks for introducing us to the two new funds from Satrix, our JSE Global Equity ETF and the Satrix MSCI ACWI ETF. Ladies and gentlemen, please keep your eyes on our social channels and emails. As soon as we have the JSE approvals in place, we will be communicating the fund dates to you. Thank you for joining us and have a great afternoon.